Welcome everyone to Name Confidential Live.
Hey everyone, welcome back to another week of Name Confidential. I'm Branden DuCharme, your host, and I'm joined today by Mike Green of Tier 1 Alpha. And boy, what a treat it always is to talk to Mike and get his take. He has such a unique, I don't know that it's really unique, but in-depth take, and has done a lot of research about the effects that the adoption of passive or systematic investing has had on markets. And I think we can all, as active managers, agree that sometimes the markets really just feel sometimes a little funny, and we can't quite put our finger on it, or signals have degraded, or there's just stuff going on. And I think Mike helps in his work sheds some light on that. So I'm really excited to give Mike an opportunity to share some of his thoughts with what's going on. Is that a fair analysis of the work, Mike?
Absolutely. And, again, the work that I do is largely around market structure as it relates to markets themselves. So much of what people are experiencing that feels like what many describe as the Costanza market, right? You should do the exact opposite of what you think is the right thing to do, is unfortunately a byproduct of how markets have evolved and how market structure has changed with the growing role of passive strategies, the growing importance of things like option trading, which is really what Tier 1 is all about, and the growing impact of the small retail trader who has become far more influential, certainly relative to the active manager space. And so we can talk through each of those components and hopefully give people a little bit of an insight in terms of what is actually changing.
Yeah, I would love to dig into that. Where do you think it'd be the easiest to start?
Well, let's start first with some of the tier one stuff. So let me actually just show you. So on tier one, which is a data service that we launched, one of the downsides to the ETF business and the compression of fees is candidly, there's just not as much money as there used to be for research. And so despite the fact that Simplify has now grown to a roughly $10 billion ETF firm, research budgets are tight. And so I run or participate in a firm called Tier 1 Alpha. I'm actually the senior advisor to Tier 1 Alpha. They're working off a lot of the theories and frameworks that I've created in the past. We distributed through Hedgeye. Um, I'm sure Branden would be happy to provide you with contact information if you're looking for us, but it's just tier1alpha.com. And if I think about, kind of like what the most important thing to understand about how markets have changed is the growing dominance of things like passive strategies in which they operate off of very simplistic, almost HODL-like characteristics and a momentum reinforcement component. And this has been a byproduct of how people access the market. And so we can talk through some of that detail. As we think about the tier one stuff, the other thing to understand is the growing dominance of strategies that are focused around options have moved the option market into one where it can often be the tail wagging the dog. And so one of the first things we always try to orient people to is when you enter into strategies like call overwriting, or you enter into strategies like cover hedged equity strategies where you're selling a call and buying a couple of put spreads, remember in those equations, you're actually selling options to dealers. And dealers don't want your options. What they want is the commission associated with the options. They want the bid-ask spread. And so the most important thing for them is not the directional signal that's coming from that information, but instead what it requires them to do from a hedging framework. When we're in a regime like we're in right now, where effectively lots of options have been sold to generate income, that leaves the dealer in what we call a positive gamma exposure. That means that if the market goes up, they actually find themselves more long the market. The reason why is because you've sold them a call option. Perversely, that actually creates conditions where they now want to reduce their exposure, so they sell futures against that, or they will sell other options against that, typically 0-day expiry options, that mute their overall exposure and basically try to delta hedge their portfolios. That's why when markets get to these all-time highs or near all-time highs, we invariably find ourselves in a position where volatility gets crushed. And basically you push down the implied and realized volatility levels far further than you otherwise might have done in the past. We're currently in one of those regimes. And so even though data is uncertain, we've got a lot of political uncertainty, et cetera, without the pressure that this is creating on dealer balance sheets that's caused by markets going down, moving those dealers out of positive gamma into a different framework where they have to hedge in the same direction as the market, it creates these low volatility conditions. And so this is one of the charts that we share, just showing the positioning of that. The green line is where we are currently, relatively close, somewhere around 63.50. Will shift back again into negative gamma. If that were to happen, we would expect to see things like volatility begin to rise. The VIX would probably spike, and the market would start pricing in some more downside exposure. Another way to think about that is simply to look at that gamma volatility exposure relative to the realized volatility. And so this is kind of another one of the things that we highlight, in regimes in which the dealers are positive gamma, it's just really hard to generate significant movements in volatility. Once you shift out of that region, it's not so much a catalyst as it just raises the potential for a much higher volatility regime. And so this is one of those characteristics that we're encountering right now, and it's largely a byproduct of the growth of option strategies. The role of active managers, since this is NAAIM, it's worth actually highlighting how radically that has changed. Because if it feels like you're overwhelmed, by all sorts of behavior around you, it's not your imagination. And I just want to highlight for people how radically the market structure in terms of who's actually trading has changed. And so let's see if I can zoom that in there. So this is what the market looked like in 1995. I came into the markets in 1992. Right after I'd managed to blow up the savings and loan industry and create the bailouts associated with it. I thought that'd be a good time to switch into the equity markets. That's a joke. I graduated college then. But in 1992, passive was a tiny share of the market. Active management represented the vast majority of activity, and active managers have their own particular characteristics. I'm going to show that in a second. It'll make perfect sense to your audience once you see this. But the really crazy part is that active management has shifted from about 80% of the daily trading activity to today, it's about 10% of the trading activity. And I usually focus on this decline in active management to highlight it, but I also want to show a couple of other things, which is, one, the impact of passive is basically everything above here, right? So this is passive market making, passive direct trading, passive indexes and derivatives, and then the derivatives and the single stock components, which have that characteristic that I was referring to before, lots of structured products, et cetera. There's a small segment of other that is difficult to ascertain exactly what that is, but that can be everything ranging from large institutional accounts to unrecognized retail traders that are of a particular size. But the other thing I wanted to highlight is actually the growth in speculative trading. So the lowering of commissions, the introduction of zero commission trading, particularly on things like options, on platforms like Robinhood, et cetera, has expanded that universe dramatically. And it also has changed the character of research in markets. So if you go back to 1995 or even into, say, 2010, if you looked at your inbox as an institutional investor, what you were almost always seeing is tons of research reports on fundamental information, right? What are the earnings expectations for Amazon? Today, if you look at the reports that are coming out of places like Goldman Sachs and others, they're increasingly focused on flow and positioning. How much are people buying of ETFs? How much are they buying of futures? What's the positioning of CTAs? What's the positioning of investors in terms of flow and aggregate exposure relative to history? That is unfortunately perfectly consistent with a world that is dominated by investors who are not being thoughtful about fundamentals, but instead are largely claiming the participation trophy. I want time in the market. I want pure beta exposure. I'm going to buy the S&P 500, or I'm going to buy a total market index. That characteristic is really driving a lot of what we see. And then to identify how this changes the market, it's actually worth highlighting that there's been a ton of research that has really developed over the last decade that most asset managers are simply not familiar with, because candidly, we spent our formative years either learning in school or studying for the CFA or the CFP. Those materials are ancient, right? There's the expression in science, science advances one funeral at a time. I would argue in financial markets, financial market understanding and knowledge advances one crisis at a time, right? And part of that is a function of it forces us to change the literature and understanding of it. But when I began doing research on this, I was really surprised that nobody had really done any work on kind of how managers behave in aggregate and how that influences market performance. And so I would just highlight that I went out in 2016 as I became aware of these growing distortions that were coming from passive investing. And before you can start talking about markets being broken, as David Einhorn or others have said, or as I've highlighted, that passive is fundamentally changing the market, you kind of have to understand how active managers behave. And so I went out and I surveyed investors and I asked them a really simple question. You're a portfolio manager, you have 5% of your portfolio in cash, so cash is not really a constraint in one direction or another, and you receive an inflow or a redemption. What's the likelihood that you will deploy funds or sell securities to meet that redemption given a normalized Shiller type valuation? We got about 450 responses. These are the aggregated impact, and totally unsurprising, as valuations rise, your marginal propensity to buy falls, your marginal propensity to sell rises. That makes perfect sense if you think about it in the framework of higher valuations, all else being equal, will lower my future expected return, right? Mm-hmm. What was really surprising was the fact that this simple survey had almost a 50-50 intersection at 16 times, which for those of you who are paying attention to this stuff in history, that's exactly the historic market multiple, right? And this is when you actually then feed these responses into an agent-based model. And so this is creating 10,000 synthetic investors, and it's giving them the responses from the surveys somewhat randomly. And it's saying, what happens if I add cash or take cash away from markets? And what you discover is mean reversion. The market centers around its historical valuation. As valuations rise, people become less willing to buy, more willing to sell. As valuations fall, they become more willing to buy, less willing to sell, and markets exhibit mean reversion. Passive investing, importantly, is really not passive investing. The definition of passive investing is somebody who never transacts. They always hold. And if you go back to Bill Sharpe's Arithmetic of Active Management, the 1991 paper that almost everyone is familiar with because of its implication, not the paper itself, this is the source of the language, as you hear, that says, well, active and passive ultimately own the same things in aggregate, and therefore the only difference between the two in terms of performance is going to be fees. It turns out that that's not at all true. First of all, those rules require passive to never transact. Where I started to get really interested in this is in 2016, a partner at AQR, Lasse Peterson, wrote a paper called Sharpening the Arithmetic of Active Management, in which he identified that when indexes themselves change constituents on index rebalancing, that changes the portfolio that the passive managers have to match, and therefore they're forced to trade. And in his analysis, that causes them to no longer be passive managers. They're forced to become active managers who operate off of a really simple algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. What am I going to buy? I'm going to buy things in proportion to their market capitalization in the index. What am I going to sell? I'm going to sell things in proportion to their market capitalization in the index. That 100% propensity to transact, where valuation doesn't play a role in that answer, actually causes the market to shift. So as passive gains share, you're adding more and more market participants who have 100% propensity to transact on flows. That shifts the market away from that historical 50-50. And if you run this through as passive share gain, what it leads to is rising valuations. Effectively, more money is going to people who simply buy, and they buy more with the next incremental dollar of whatever has gone up, whereas active managers in general would sell that security, right? So it changes the market behavior quite dramatically. And unfortunately, that perfectly matches what we see in the market structure. All stocks are rising in valuation. The largest companies are rising dramatically more, and there's reasons for this as well. But the simple math is most active managers bias towards small and value, as we saw in the responses. That actually creates conditions where if active managers are getting fired and passive managers are getting hired, the largest stocks are actually the biggest beneficiary of this outcome. Pause there for a second and let people digest that, and maybe you can ask a question so I can take a breath there, Brandon.
It's always a lot to take in. I always feel like the more we talk, the more it just makes almost intuitive sense to me. And it is that structural reinforcement from the momentum aspect. I know one of the things that I've considered and just gone and looked at in my simplistic, puny, human brain is just saying, okay, if Bill Sharp's theory around passive is passive, and there's nothing else at play here, then all else being equal, your equal weight index should be outperforming the momentum trade that's in the market cap weighted indexes, right? And so to me, what that told me, when you go and look and you see the outperformance of a market cap weighted index relative to the equal weighted version, that's essentially like the momentum premium, if you will. But that momentum premium is largely just self-reinforced, and I think that's what you're highlighting here. I mean, this is like a very simplistic and rudimentary way to look at it, but am I on the right track here?
Yeah, I think that's right. And in fact, there's a couple of papers that have come out. The most important one on this particular phenomenon, I would actually highlight, is from an academic named Zhang at the University, Michigan State University. Let me see if I can pull this up here. There we go. So this paper here, Passive Investing in the Rise of Mega Firms, actually hits on exactly this point, right? So flows into passive funds raise disproportionately the stock prices of the economy's largest firms, especially those large firms that the market overvalues. So just mechanically think about this. If you're buying a market cap weighted index, the largest weights, almost by definition, or at least the largest relative weights, are going to be companies that are overvalued. Right. Again, the response from the active manager community that thinks about it from a valuation framework would be to say that therefore means those companies are overvalued. I should own less of them. That causes prices to retreat. Passive does the exact opposite. I'm going to assume the market is right. If the price goes up, that's reflective of future fundamentals. And therefore, I'm going to buy more of stuff that goes up. That reinforces this underlying dynamic. The second thing that is going on here is in the actual structure of the indices and the replication process itself. And so this is a second academic. I'm just going to share the screen here. This is from Valentin Haddad, who wrote a paper called How Competitive is the Stock Market? And this was going at the heart of one of the theories behind the efficient market hypothesis. You'll hear very smart individuals like Cliff Asness talk about, there's never cash on the sidelines. For every buyer, there's a seller, right? That framework led to the efficient market hypothesis, in which every individual investor basically has a voice that they get to vote with their information content. There goes my dryer. Give me 1 second here. Okay, now that that's gone off. Okay, so it turns out that actually markets are highly inelastic. And so the specification for the EMH is that $1 into the market, by definition, means $1 out. Therefore, it doesn't change market caps very much at all. The actual assumption is that market capitalization would rise about 1 penny on that transaction. It turns out that the market is highly inelastic. $1 in creates somewhere around $8 worth of market capitalization, and that changes radically based on what type of company you're buying. This chart from Haddad's paper highlights a really important component, which is this is market capitalization expressed in log 10 terms. So 12.5 is about $3 trillion. These are the largest companies, and they are almost perfectly inelastic, meaning that prices rise an almost infinite amount when you try to put money to work in them. And the reason why is very straightforward. Everybody has to own these in a passive framework. So if I'm replicating the S&P 500, I have to own NVIDIA. I have to own Microsoft. I have to own Apple. Do I have to own United Airlines? No, I don't. And in fact, because most of the net flows represent a sale of active managers and a buy of passive managers, what I'm doing is I'm even outstripping the theoretical frameworks in this transition period. Effectively, these stocks are getting net bought. These stocks are kind of net getting sold. And as a result, large outperforms small on a somewhat continuous basis and in a manner that candidly defies almost everything that we were taught. The Costanza market at work.
So I mean, one of the things about inelasticity, right, is that, like, I just go back to remembering the rubber band, right? So the more it's stretched, at some point, the snapback is bigger and more significant. Do you think that would your work suggest that that's adding to the increase of these volatility events that we have, where there's a sudden sharp drawdown in the broad market and a subsequent quick recovery?
Yes. And so one of the ways to think about that statement, right? Remember that, when we think about the rubber band snapping back, there's two separate phenomenon that are actually playing out there. One is because the rubber itself has limited elasticity. It'll eventually break if you push far enough. But the much more common outcome is you stretch the rubber band and you don't pay attention. Your thumb is bending a little bit, right? And that rubber band snaps back and pulls off. Effectively, the frictional component of the rubber pulling itself back exceeds the force that you're pushing into it. But if I maintain that pressure and keep stretching and I don't hit some, framework limit, and remember, we're dealing with financial assets here, so there are very few finite limits, right? There's nothing that says Apple can't trade at 100 times earnings or 200 times earnings, right? There is no real limit to that. The money that is flowing into passive strategies is effectively a force that is being applied and loaded. And I can show you a couple of other charts that hit on this. But again, the really interesting phenomenon here is how we choose to invest plays as much, if not more, of a role in how markets behave than our simple decision to invest, right? If we decide that we're going to buy stuff that goes down and sell stuff that goes up, we experience mean reversion. If we decide to buy more of stuff that's going up, we experience mean expansion. And that's really the framework that has changed here, is that we've created a loading factor that is pushing markets to extremes that we have never seen before. But that doesn't mean that they are a limit in and of themselves. Where I think the limits do emerge, though, is in a different framework. And this speaks to something like the Buffett indicator. What the Buffett indicator is showing is showing total market value relative to total income. Market capitalization versus GDP. GDP is just another way of saying the income of a country spread across the government sector, the corporate sector, and the household sector. The thing to remember is that contributions are always going to be a function of income levels. Withdrawal levels are always going to be a function of asset levels. So you take a fraction of your wealth and you withdraw it in a 401k type framework, or if you're a wealthy individual who's choosing how to spend your resources, or if you're a nonprofit or an institution, you typically will set your withdrawals as a percentage of your balance. The contributions are always going to be a function of your income. The higher that ratio, market value to income, gets, the easier it becomes for the system to experience net outflows. When you experience net outflows, if those outflows come in passive, the multiplier effects are huge.
You're saying because you're stretching it, but if the load factor changes, which the load factor is flows, right? Just flows. And now I want to, I'm a very wealthy individual that wants to buy a yacht. I will sell some of my passive funds I've been holding forever because they're so, they've done so well. And so I sell, and that creates the outflow. And all of a sudden that's the force that allows the release, so to speak, on the rubber band.
Yeah, I mean, that is one way of creating that release. But you highlighted a really interesting point, right? When we think about wealth and you think about the stock market level and the wealth that is associated with that, assets that you just described, things like houses or things like yachts, are probably the extreme. Those are the ones that are actually most affected by this wealth effect, right? If I make $10 million in the stock market, I feel much more comfortable swapping a portion of that asset for another asset called a yacht, right? Therefore, the wealth level in the stock market will influence the demand for things like yachts, in particular, housing, as well as typically something that you are taking an appreciated asset that often represents your down payment or even more than that, or in today's world, very generous parents subsidizing their children buying a house. Those asset levels bleed across into other asset levels. There's not an awful lot of people that are evaluating whether they buy ice cream at the store on the basis of their wealth in the stock market. And so those things are much, much less affected. And so this contributes to that phenomenon that we're experiencing broadly of asset inflation relative to goods inflation.
Okay. Yeah, there's always so many points to think about on this. So I mean, we only have a couple minutes left, but what's sort of the idea around the end game to all of this? Because I believe there's a quote out there from Jack Bogle, the man himself,
Yep.
right? If everyone did passive investing, it would be like catastrophe and a big calamity and chaos,
Yep.
right? And I I've sort of been joking now for like the better part of a year that like the best thing passive investors could have done is figured it out and then shut up. And they probably could have rode a pretty reasonable gravy train on Bill Sharp's original idea. But the issue really seems to be coming from not the not systematic investing. There's nothing wrong with that, and there's an argument I think at its core to be made. But it's really this adoption where everyone's doing it, and it's causing this distortion, right? I mean, that's sort of the
Yeah, I mean,
concern, right?
it really is the critical component. And so, just very quickly, let's parameterize this, right? If we look at how much passive has grown, it is really an astonishing change in market levels. And so back in 1995, passive was only around 2% of the market. Today, in 2025, it's north of 50% of total market capitalization is now invested in passive strategies. That's combining the holdings of Vanguard, BlackRock, futures, total return swaps, separate accounts, index option exposures, et cetera. All of these ultimately magnify all of that. And most importantly, I would just emphasize that we often see the retail side of the equation. We see the Vanguards. We often are missing the institutional side, which actually has even deeper penetration because candidly, people just want cheap beta, right? They've been trained and taught to focus on this. And so what we know from exactly the Bogle quote that you highlighted is that, and I include that in my presentation, actually, if everybody indexed, the only word you could use is chaos, catastrophe, the markets would fail. That's just a thought experiment, right? If everybody is just holding and nobody is doing any work, the markets don't have the ability to do price discovery. And so prices would move in an insanely volatile way. If everybody's passive, one day markets would be infinite, and the next day markets would be zero, and the next day they'd be infinite, and the next day they'd be zero. And it'd simply depend on were you trying to transact or not, because there'd be nobody to buy from you, right? Bogle's analysis was focused on that framework, and he kind of roughly arrived at the idea that about 85% passive markets would no longer be capable of price discovery. I can recreate that using just simply static models. And the way to think about this is at 85% passive, the dollar value of passive transactions would so totally overwhelm the active participants that they would have to hold extraordinarily high levels of cash in order to facilitate trading activity. That won't happen, and therefore markets begin to break down in a material way. What Bogle missed in that analysis, though, is the process of shifting from active to passive. In order to get to 85%, you have to have more than 100% of the marginal flow coming into passive strategies. You effectively have to start shrinking the active manager community. And as this chart shows, that's actually roughly what happened around 2015. Which for many market participants was a period that felt like a break, right? Like it just felt like something changed. Certainly did for me at that point, which is why I began doing this research. It was coincident to Lasse Peterson releasing this piece. And for me, this really started to solve a lot of the questions about what was actually happening in markets. Unfortunately, again, this just echoes that basically there is no price discovery. The active managers at this point are so overwhelmed with trying to maintain their own positions and simply stay alive in markets that they're no longer really an effective check. I often describe it as, we are the child screaming, "The emperor has no clothes," right? They're supposed to pay attention to us. The problem is we're at a nude beach. So everybody already knows the emperor has no clothes, and it doesn't matter what we say, right? The greeting that you're going to get in response to that is something along the lines of, "Okay, boomer."
That's so I guess the big unanswered question that I think we get to leave everyone at the cliffhanger of, as we're 2 minutes over time, is like, so what happens between here and 85% adoption? What is the path, the future path look like? And I don't know if your framework has an answer to that or not, but it seems like there's uh, just more peculiar times ahead. Oh, you're on mute, Mike.
I muted myself because I've got a dog barking now. I've got a
Oh,
drop and a dog barking. I'm a very professional podcast guest. So I think that there's a couple of things around that. Brandon, you obviously know that when I discovered this, the first thing I did was look around for ways that I could actually construct a trade on it. What I recognized was that there were already strategies that had hit levels of passive exposure that actually meaningfully changed the potential outcomes. This was actually the XIV and the trade around the XIV, which is something that I flagged in advance in May of 2017. I identified this, said, look, at any point in time, the inverse VIX ETF complex is accounting for about 70% of the daily trading activity that's happening in the VIX futures all by itself. Forget anybody else hedging, any other activity, anyone trying to do fundamental analysis around what the volatility surface should look like, et cetera. It had effectively just been overrun by systematic strategies that simply sold volatility always, right? Once this got to that scale, it actually became very predictable to say, what is an event that's going to be required in order to create this product, going to cause this product to go to zero? And the answer turned out to be surprisingly easy. It would just require a 4% one-day decline in the S&P 500. At the volatility levels we were experiencing in 2016 and 2017, that suggested that it was about a 95% probability over the course of 2 years. We were able to construct a trade that took advantage of that. The market was pricing it at a less than 3% probability. We saw it as a 95% probability. We were able to position ourselves to profit from it. But this, unfortunately, is what happens when you exceed that passive threshold and passive starts to sell. There's simply nobody who can match the scale and buy underneath to effectively force it up. What we've seen so far has actually been the exact opposite. It's been active managers like myself hyperventilating and saying, "Oh my gosh, we're putting on tariffs. It's Smoot-Hawley all over again, right? The world is going to fall apart." And we basically move our positioning, get ourselves positioned bearishly. And once we've done that, I like to use the analogy of John Belushi in the movie Animal House, right? Who's with me? Nobody follows him, right? Because there's nobody else, right? We're 10% of the market, and we are shouting and screaming, "The emperor has no clothes. This is the end times. It's the end of the world." And nobody who invests with Vanguard or is contributing into a 401k plan or into an IRA on a dollar cost averaging basis cares. And so once we've exhausted our firepower trying to push the market down, the market goes straight back up. And that is the phenomenon that we have seen over and over and over again for the last decade. The unique feature of the XIV was because it had a single issuer, Credit Suisse, that was actually behind it. They had a force majeure clause to make sure that they would not lose money. And so what I knew was going to happen there is it would be delisted and never trade again. So I was definitely going to get paid, right? Now, even with that happening, I will tell you the funny part is I predicted this in advance, spoke about it publicly, identified exactly the mechanism. And when the event actually occurred, I got calls from lawyers at the CBOE and Velocity Shares and everybody else saying, you guys obviously manipulated the market. No, we didn't. This is just what a market does. Now, the same underlying phenomenon exists for the broader market. And that's why this is so really crazy if you actually stop and think about this. This is just a super simple model looking at the same thing in US equity markets. And it basically looks something like this, right? Which is, again, the XIV framework. We're just now hitting that point at which this becomes an exponential curve. And so if this continues, like you could see real craziness. I just want to be really clear. You could see real craziness. But when it stops, if we were to have stopped a couple of years ago, which is why I was trying to raise the alarm, I was trying to get policymakers to wake up to some of these risks. And the simple reality is they don't care, right? They don't. Number go up is just as appealing in equity markets as it is in Bitcoin. And so, I used to use the analogy, it's like driving a car uphill with no brakes. Who cares? I can stop at any time. I just take my foot off the accelerator. But if you crest that hill, you've got an entirely different set of concerns. And so that's probably the best place to stop.
Yeah. Well, I appreciate you hopping on to share your thoughts. It's always really interesting stuff. I really enjoyed listening to your work and reading a lot of the stuff that Tier 1 Alpha has to put out. I found it not only fascinating but helpful. And it's it's that like investing is not a world in which you really want to feel comfortable, but you can feel a little bit different about the markets if you feel like you have a handle of what's going on, even if it's something crazy, and I think that can provide some edge and clarity. So
yeah, I think that's the most important component. I mean, recognize that you're not wrong. Markets feel crazy. They are crazy. The question is, when do the crazy people stop being given money, right? And perversely, as prices go higher, they get access to more credit. They get access to more money. They feel more confident in themselves, etc. I mentioned earlier I was playing around with some of the data on the NAAIM website, which I strongly encourage people to check out. I'm sure everybody else has already looked at it. But things like the survey responses of positioning, etc., those actually are interesting in and of themselves, right? If you look at things like the maximum exposure that's reported in the NAAIM surveys, the willingness to go to 200% exposure, to go to levered exposure, is happening faster and faster and faster in that data series. So people used to get burned, they'd be scared, they wouldn't want to get back in. Now they've been trained, right? The market's going to rebound. It's that John Belushi effect, right? Nobody is with the bears. The entire American public and many international investors are likewise simply answering the question, do I have a job, therefore I buy stocks, right? That's a very different world than the one we've always inhabited.
Well, hopefully we haven't ruffled too many feathers in the active management community today.
I'm sure we have, but the biggest thing to keep in mind is that you're not crazy. It feels insane. It is insane, but we understand why.
Yeah. Well, one of my favorite sayings is results take time to measure.
They do. You actually, unfortunately, just gave me a reason to show one last slide here. So I'm gonna do this because this is really the death knell. Just a couple of last slides. This is actually, given the audience, this is actually super, super important. So understand that when you say that it takes time to measure results, that is because the way that we're used to thinking about markets is that the returns look something like this, right? There's a central tendency for equities and they vacillate around that. And so what you're saying is, I want to look at somebody over a market cycle to determine if their returns over that market cycle are above the expected return for the market in total.
Mm-hmm.
The problem is that when you change the system to one that we just talked about, where valuations continue to rise and the market has a positive loading for this momentum feature, it actually causes those returns to become asymptotic, right? And it turns out that alpha is literally just the intercept on a linear equation. What we're actually doing is we're saying the return of a portfolio is y equals mx plus b, right? M being the beta, x being the market return, and b being the alpha term. If you try to use a linear solution to solve a curved surface, over time, what actually happens is your intercepts get forced negative. And once again, this is exactly what we're seeing, right? So the theoretical behavior of alpha perfectly matches the observed behavior of alpha. Again, understand this is junk, right? This is me randomly feeding stuff in with no pattern, no earnings, no, skill components to it, et cetera. It's simply playing through this dynamic of what happens under this framework. And it almost perfectly matches what we're experiencing in real life. And so perversely in this world, the longer these conditions persist, the more damaging it becomes for the active manager community. And my real fear is that active managers are forced to basically closet index and behave more and more like the benchmarkers. That creates a feature we call defection, where people abandon their strategies and pursue the winning strategies. It's effectively creating pseudo-passive investors who are rushing, and everybody ends up on the same side of the ship and the ship rolls over.
Yeah.
And that, I think, is kind of where we are at this point. People have by and large given up trying to be rational and are simply saying, find me the next meme stock.
We definitely need to end it there.
There you go. All right.
I really appreciate you, Mike. It's very interesting stuff. And I appreciate you taking your time. I know you're a busy guy, and I appreciate you donating some of your time to the organization here today. So,
well, it's a great organization. As I said, I enjoy the website. I enjoy looking at some of the information. I would encourage people to check out my work and to do your own research on it, right? We'll see that the academic work is rapidly moving in this direction. It's telling us there's a real problem. Policymakers are unaware, and you as an individual investor are forced to ultimately try to keep up. There's not that much you can really do other than try to make regulators change behaviors, and they're just not going to do it anytime soon.
Yeah. Well, one can only hope and pray, I suppose.
There are some good. There is good news on that front, right? Whether you like the Trump administration or you hate the Trump administration, I will tell you they are far more open to hearing this information than the administration that came before. So I'm keeping my fingers crossed. Maybe we'll make some progress on it, but we are in for an experience, to say the least.
Well, I look forward to watching it unfold when it happens, and be an active market participant throughout. So
excellent.
Nonetheless, I appreciate you sharing your time, and I look forward to talking again soon, Mike.